Mastering options trading strategies for every market. Welcome to our comprehensive guide on option trading strategies. You want to make money in the market? Listen up. Options give you more bang for your buck. We're talking leverage, baby. We're gonna break down the barriers, cut through the noise, and give you the straight dope on how to trade options like a pro. Whether you're bullish, bearish, or expecting a neutral market, we've got you covered. We'll cover it all. Covered calls, bull spreads, bear spreads, you name it. We're gonna arm you with the knowledge and strategies you need to conquer the options market. So buckle up, get ready to take some notes, and let's dive into the exciting world of options trading. Covered call, milk that cash cow. Alright, you want to squeeze every last penny out of your stocks? You own that stock, it's your baby, but let's make it work harder for you. We're talking covered calls, people. You sell a call option on a stock you already own. It's like renting out a room in your house. You still own it, but you're collecting premium. You're bringing in the cash. Think of it as getting paid while you wait for your stock to really take off. And if the stock price goes up, booyah! You sell your shares at a profit, plus you keep that sweet, sweet premium. Now here's the kicker. If the stock price dips below the strike price, no sweat. You keep the premium and you still own the stock. Covered calls, folks, a fantastic way to generate income from those stocks just sitting in your portfolio. Bull call spread, ride the wave, limit the risk. Feeling bullish but don't want to go all in? We got you covered with the bull call spread. This strategy is for the savvy investor who wants to maximize profit while minimizing risk. Here's the play. You buy a call option at a lower strike price and simultaneously sell a call option at a higher strike price. It's like buying a stock at a discount and then putting a sell order in at a higher price. This spread limits your risk because the premium received from selling the higher strike call helps offset the cost of buying the lower strike call. Think of it as a safety net. You're protected if the market takes a downturn, and if that stock price soars, you're riding that wave all the way to the bank. Remember, this strategy is perfect for when you're bullish but want to limit your risk. It's all about maximizing those gains while staying protected. Bull put spread, the income-generating machine. Now let's talk about generating income, folks. The bull put spread is your ticket to consistent cash flow with limited downside risk. It's all about playing the odds. You're selling a put option at a higher strike price and buying a put option at a lower strike price. You're essentially betting that the stock price won't fall below a certain level. Here's the beauty. You collect that juicy premium up front, and as long as the stock price stays above the higher strike price, you keep the entire premium. It's like setting up a toll booth on a busy street. Cars are whizzing by, and you're collecting that sweet, sweet toll money. But remember, manage your risk. Choose strike prices that make sense for your outlook and always have an exit strategy. Chapter 4, Long Call, the ultimate bull market power play. Are you ready to unleash the beast? The long call is not for the faint of heart. This is for the investors who smell opportunity a mile away and are ready to pounce. You're buying a call option, essentially betting that the underlying asset is going to skyrocket. It's like buying a rocket ship ticket to the moon. The potential for profit is unlimited, but remember, with great reward comes great risk. This strategy is best used when you're absolutely positively sure that the market is going up. It's a high-risk, high-reward play that can pay off big time if you're right. So are you ready to ride the rocket ship? Buckle up, because the long call is one wild ride. Chapter 5. Bear call spread. Profiting from the downside. Markets going down? Don't panic. The bear call spread is your secret weapon to profit in a bearish market. It's like having a raincoat in a downpour. You're selling a lower strike call option and buying a higher strike call option. You're essentially betting that the stock price is going to go down or stay flat. The key here is to manage your risk. The premium received from selling the lower strike call helps offset the cost of buying the higher strike call. It's a calculated risk, a strategic move to profit from a declining market. Remember, this strategy is all about capitalizing on those down days. So, when the market zig, you zag. Chapter 6. Bear put spread, the calculated bear's delight. Feeling bearish, but don't want to risk it all? The bear put spread is your answer. It's a more conservative approach to profiting from a declining market. You're buying a higher strike put option and selling a lower strike put option. You're essentially creating a limited risk, limited reward scenario. Think of it as a safety net. You're protected if the market takes a downturn, but your profit potential is capped. This strategy is ideal when you're cautiously bearish and want to limit your risk. It's all about playing it smart and minimizing your downside. Chapter 7. Long put. When you're betting on a market crash. Are you ready to embrace the dark side? The long put is not for the faint of heart. It's for the investors who see storm clouds gathering and want to profit from the coming storm. You're buying a put option, essentially betting that the underlying asset is going to plummet. It's like buying insurance on your portfolio. The potential for profit is significant, especially in a bear market. But remember, timing is everything. You want to buy your put options before the market crashes, not after. So, are you ready to weather the storm? The long put can be your umbrella in a downpour. Chapter 8. Covered put. Short selling with a safety net. Now let's talk about the covered put, a strategy for the bold investor. You're selling a put option on a stock you've shorted. It's a way to generate income while waiting for the stock price to fall. It's like renting out a car you don't own yet, hoping the price will drop so you can buy it later at a discount. This strategy can be risky, but it can also be very rewarding if you're right about the direction of the market. Just remember to manage your risk and have an exit strategy. Chapter 9. Iron Condor, the Market Whisperer. Listen up, volatility traders. The Iron Condor is your secret weapon for profiting from a calm market. It's like setting up a net to catch falling leaves on a windless day. You're selling a call spread and a put spread, creating a narrow range where you expect the stock price to stay. If the stock price stays within that range, you collect the premium and walk away a winner. But remember, the Iron Condor is all about timing and precision. You need to be right about the direction of the market and the level of volatility. Get ready to ride the wave of uncertainty. The straddle is for the traders who live for volatility. It's like strapping yourself to a rocket. You don't know which way it's going to go, but you know it's going to be a wild ride. You're buying both a call option and a put option at the same strike price. You're essentially betting that the stock price is going to make a big move, but you're not sure which direction. This is a high-risk, high-reward strategy. If the stock price makes a significant move in either direction, you could make a killing. But if the stock price stays flat, you could lose your entire investment. The strangle is similar to the straddle, but with one key difference. You're buying an out-of-the-money call option and an out-of-the-money put option. This means your break-even points are further away from the current stock price. It's like setting a wider net. You have a higher chance of catching a fish, but you also need a bigger fish to make a profit. This strategy is best used when you expect a significant price move, but you're not sure which direction the market will go. The butterfly spread is a neutral strategy that profits from low volatility. It's like setting up a tent in the middle of a calm forest. You're protected from the elements, but you're not going to catch any wild animals. You're using multiple strike prices to create a narrow profit range. If the stock price stays within that range, you make a profit. But if the stock price moves significantly in either direction, you could lose money. This strategy is ideal for traders who believe the market will remain stable. It's a low-risk, limited-reward strategy that can generate consistent income. There you have it, folks. We've unlocked the vault of options trading strategies and given you the keys to the kingdom. Remember, knowledge is power, and with the right strategies, you can conquer the options market. Thanks for watching. If you found this guide helpful, don't forget to like, share, and subscribe for more trading tips and strategies. Let's make some money. Now go out there and make some money, but remember, always trade responsibly, manage your risk, and never invest more than you can afford to lose. Happy trading.